Hello and welcome to our special Davos coverage. We're coming to you from inside the Congress Centre, and I have with me the CEO of Unilever and the non-executive chairman of Hindustan Unilever, Harish Manwani. Mr. Manwani, great to have you. Thank you for your time.
Menaka.
I want to get your view on the global economy. I want to talk about the trends for 2013, but the recent news that Hindustan Unilever put out forces me to pick that up as the first issue. So excuse me while I go through the royalty issue. There is considerable disappointment at the upping of the royalty, and I think that combined with the slower growth that you've posted in this quarter, the deceleration in volume growth has led to a spate of brokerage downgrades. Take me through each one of these issues as you see them.
Well, let me first say that I'm really pleased with the performance of Hindustan Unilever.
Okay.
Last couple of years,
despite the slowing down of growth,
because ultimately you have to look at what growth we've achieved. We've achieved a 15% growth, and by the way, if you take the last 4 quarters, we are averaging half of that in terms of volume growth. And the fact is that for the last couple of years, we have now begun to deliver consistent performance, competitive performance ahead of markets, and profitable growth. As far as I'm concerned, that's exactly what we started out to do, and that's exactly what we are doing. Now, you talked about the matter of royalty. Firstly, let me assure you that the board unanimously approved the proposal for the royalty increase by 1.75%. And that was done after all the due diligence, where the board was convinced that in the context of the way Unilever is now organized, where we are trying to take a lot of, if you like, costs globally, so that we can leverage the global scale of Unilever to provide even more support to our operating units. It's in that context that the costs were reviewed, and more importantly, the benefits to Hindustan Unilever were reviewed. And I'm pleased that after having done all their due diligence, the board unanimously approved the proposal. So, as far as I'm concerned, the benefits that you are seeing of better innovation, lower costs, good and best practices is a combination of what Unilever brings to HUL and what HUL is doing brilliantly locally. So it's a global-local combination. That's the winning combination.
Okay, I understand. I also understand the fact that the royalty that Hindustan Unilever is going to pay its parent, effectively, is in keeping with the band of 3 to 3, and 3/4% that many MNC subsidiaries in India pay. So it's not an outsized royalty. It's not extraordinary, but yet there is concern. So I'll bring some of those concerns up. I think people want more specific information as to what that royalty is, contributing to the Indian business, specifically outside of the broad wording that was available in your press release. I think the second aspect is that in an environment of slowing growth, some analysts believe that your volume growth has peaked out at a time when anyways economic growth is so uncertain that this is going to be a big dampener on shareholder returns and on the stock price. How do you respond to those issues?
Well, I think, as far as the royalty is concerned, we cannot get into every detail of that, either with individual investors or media. That's the role of the board. Let me assure you that the board would not unanimously approve any proposal unless they've asked exactly the questions that you asked. Is this fair? And does it give benefits to HUL specifically? Let me tell you the 2 areas specifically out of it. Innovation. The stepped up rate of innovation. I mean, let's face it, for the last 8 quarters, every time we met the media and investors, we have been welcomed by saying, what a great change in Hindustan Unilever. Okay? And now all that has been made possible because our innovation rate has been stepped up. And the second bit is if you look at our cost base. For example, we do all our commodity buying. Commodities are global. We do all our commodity buying now globally and centrally. So there are a lot of functional support, enterprise support, engineering services, supply management, and most importantly, innovation. That is being done more and more globally. In the past, a lot of the activity systems were being done locally for local. Now, a lot more activity systems are being done globally in order for Unilever to take advantage of its scale. We are a 50 billion euro business. We want to bring the scale and might of 50 billion to every operating company. And let me assure you that every cost has been scrutinized by the board. That's their role. And that's been done. All the due diligence has been done. So that was first. What was your second question?
Okay, let me rephrase my second question then. Is there a chance that you could have done this in phased increases?
It is, in fact. That's the other thing. The way it has been done is, first of all, the specifics are that the royalty has been increased from a current level of 1.4% to a level of 3.15%, which is an increase of 1.75%. And that is going to be 50 basis points between now and March 2014, and from there on, okay, within the next 4 years. So in other words, a total of 5 years, maximum of 5 years, and a band of 30 to 70 basis points every year after March 2014. This is a proposal that the board has considered is the right way for HUL to support the royalty proposal. And by the way, in all this, you have to be fair to Unilever in terms of ensuring that they get fair recovery, and you have to be fair to HUL, all our shareholders of HUL, that they are getting the benefits. It's exactly this sweet spot that the board had to consider before they approved this.
Is there any chance that you all might review this, given the kind of opposition we've seen in the analyst, investor and shareholder community?
Menaka, I'm not aware of the opposition. We've just announced it. The media obviously will pick this up. But I think the more important thing that you have to look at is the performance of HUL in terms of where we were. Take 3 years ago and where we are today. By the way, we are adding at the rate, we talk about growing our business 15%, almost half of it coming by volume, through volume, on a base of the kind that Hindustan Unilever has. We are creating an equivalent of a medium-sized company every year. And by the way, so that you know, large part of our business, in fact 70% of our total business is actually winning market share. Consistent growth, profitable growth, and competitive growth. That's the mantra. I want predictability in our business. I want to make sure that we are able to deliver good results every year. Now, does it mean that every quarter will be exactly identical to the other? It cannot be. We run an operation at the end of the day. You know what I'm saying?
I'm not asking that in the least. Okay, I want to read out an analyst comment to you. This is my final question on Hindustan Unilever, but I want you to respond to that and talk to me about the kind of growth you expect to see for Hindustan Unilever in the context of this comment and in the context of the global uncertainty we are seeing for 2013, right? So here's what one brokerage house had to say, that HUL's volume growth, which is halved in the last 4 years and is the lowest in the last 3 years, is indicative of the increasing pain points in the existing portfolio. To add to this, the new product pipeline is capped to Unilever categories which prevent Indianization. We believe this will result in the innovation funnel drying up, thereby making it harder for HUL to achieve relevant volume growth in the longer term. They go on to say, we believe lack of incremental growth drivers in the product portfolio, the royalty overhang and moderated profit growth outlook will take its toll on valuations.
Well, I have not come equipped with all the... hang on.
In the context
I'm
of...
saying I have not come equipped with a lot of the positive comments that investors and analysts have made over the past 1 year and as recently as the previous quarter.
How investor memory is.
I'm just trying to answer your question that at the end of the day, Menaka, we have to recognize that there is some news that we've given here.
Right.
People have to digest the news, understand the benefits, as indeed the board has done. Now, if an analyst or an investor is unhappy about it, we are very happy to sit across the table and be able to explain it.
Respond to this comment on slowing volume growth, on the lack of further innovation in the product pipeline, and on the fact that all amounts to lower valuations at a time when 2013 anyways holds uncertain forecasts for growth.
So the only answer I can give you is that the business is growing competitively. There is absolutely zero evidence that innovation pipelines are drying up. In fact, we've had more innovation than we've ever had in recent history of Hindustan Unilever. And I don't see why, unless someone knows more than I do, which could be a little difficult, that our innovation is going to slow down. In fact, I don't mind telling you this. I expect our innovation to be bigger, better, and even faster as a consequence of the way we are organized and the way we are executing in the marketplace.
Talk to me about what 2013 will bring the world. Forget Hindustan Unilever. Look at your entire portfolio and tell me whether you think this is a year that you will see demand growth in many pockets of the world and more pockets of the world than the pockets that you will see either a stabilization of demand or a deceleration of demand.
Well, let me first remind the viewers, and more importantly, I remind myself and our employees we've had more uncertainty in the last 2 to 3 years. Okay, this is the new normal. Businesses have got to get used to this whole volatile, uncertain, ambiguous environment. I do believe that we've had enough practice to deal with that. In other words, we have to deal with our businesses more dynamically. We have to make sure that we are able to, if you like, continue with our mantra of business as usual on growth and business unusual on costs. What's the outlook for 2013? I don't know, but if you look at the mood around here, I would say people are feeling a little more optimistic, but there is absolutely no question that the clouds are still, there is an overhang of clouds as yet. And therefore, we have to be prepared for another year, which may be a bit like 2012. And I don't worry about that, because I do believe that as a business, we will continue to do what we have done well. As Unilever, you saw Unilever's results, by the way. I mean, we've declared one of our best results in the last few years. And we are again getting into a rhythm of consistent growth, competitive growth and profitable growth in Unilever. We crossed 50 billion mark. We are now, our margins have gone up, our profitability has gone up, our top line has gone up. So the good news is that as an organization, we are able to really manage our business in the context of the environment that we operate in.
Okay, final question then. Where do you see the growth coming in this year and next? There will be markets that won't do very well, maybe parts of Europe. There is the political overhang in the US. Is it still the BRICS in the emerging markets, or has the order in that as well changed when it comes to the maximum growth potential?
Firstly, the way we manage our businesses, whether you happen to be in Europe or the developing markets, your job is to outpace market growth. Now, if the markets are flat, we expect a little growth. Just to tell you, in Europe, for example, in spite of all the stress, economic stress, environmental stress last year, we actually had positive volumes. We grew in North America. We grew more share in North America than we've done before. So the approach does not change. Of course, the growth rates will be different. So where do we expect a lot of our growth? 55% of our business is in the developing markets. And 90% of our growth last year came from developing markets. Now, as far as I'm concerned, we have to be focused around making sure that our businesses in developing markets continue to grow. I have no reason why we should not.
Will the order change in that? Because, this year I'm hearing a lot about Russia and Indonesia here, less about China and India, even though China has outperformed its, growth targets. So I'm just curious to know whether the order of the markets within the developing market basket, is that changing according to you as you see more demand come
for
on
a business
online?
like ours, where 55% of our business is in developing markets, you cannot just say I'm going to focus on 3 markets.
No, not focus. I'm just saying, where is the growth more likely to come from? You may continue to focus on everything.
The way we look at it, there are the BRIC markets, and then there are what we call the next 13, which are all markets which are likely to have population of 100 million plus going forward, or have sizable population where we've got a big presence. Take Argentina, for example, or Poland, for example. They may not be populations of 100 million, but we have huge businesses here. As far as we are concerned, we are driving all these big markets, and at the same time, keeping an eye on some of the emerging markets, the nascent markets, the frontier markets like Africa. So, if you're asking me where are we going to go focus, obviously our first focus will be in our big core markets. Our second focus is to make sure simultaneously we are investing in the white, quote unquote, the white spaces that still exist. The beauty of our business is that we still have almost 2/3 brand country combinations where one or the other brand is not present. And that's a fantastically energizing opportunity that we see. So, do we expect to see developing markets continue to grow? The answer is yes. Do we expect them to grow higher or slower? I don't know. It doesn't matter. We will always want to outpace market growth and, more importantly, lead market development. A lot of our growth, by the way, comes because we lead market development. We develop markets. Okay? Well, when you're market leaders, if you sit back and say, I'm going to wait for the market to grow before I grow, that itself may not be a very proactive policy.
Okay. Outside of the economic uncertainty, what are some of the other challenges that you would count in 2013? Input costs is one that, I'd like your view on. Royalty, outside of being the India issue that we just discussed, is also becoming a big transfer pricing, profit export issue across the world. So I'm wondering whether, look at what's going on with Starbucks or many of the other large conglomerates in the world who are facing this issue. So what would you count on your challenges list outside of the economic uncertainty and the don't knows that we...
I think you have to contextualize all the issues and problems and challenges in the context of opportunity. I see three big mega trends.
Okay.
Number one is the move towards the developing and emerging markets. Number two is digitization. Okay, it's fundamentally changing the way we talk to our consumers and the way shoppers will buy product. It's fundamentally changing.
Give me an illustration of how you've sort of worked with that.
Just to tell you, last year, for example, our digital expenditure went up by 40%. Now that's only money, and that's, by the way, from a small base. We are into a strategic alliance with every big social network,
right.
And companies like Apple, Google, Facebook. We are actually, we've developed a strategic alliance so that we can actually begin to learn how this media works, both in the context of communication and moving away from what we used to call paid media to earned media, and equally e-commerce. E-commerce is a big deal. So what have we done? We've created a global cell for e-commerce, which will actually build e-commerce and digital capabilities amongst all our marketeers and all our businesses across the world. 2,000 of our marketeers have just been certified as being digitally savvy. And this program must continue because building capabilities of an organization prepares them for the future. The third big trend is sustainability. We live in a resource-stressed world. Our business model is we grow, but we grow responsibly.
Right.
So that's the fourth G. So I've been talking about consistent growth, competitive growth, and profitable growth. The last one is responsible growth. That's our model.
All right. Thank you so much, sir.
Thanks very much.
You spent the time in a rather busy day. Thank you very much for that.
What a pleasure it was.
Absolutely,
Bye-bye.
Mr. Manwani.
Thanks.
Thank you so much.